If you can copy a photo, a song, or a document almost for free, why can't someone just copy a Bitcoin? That simple question is the doorway into what Bitcoin is really trying to solve. Bitcoin is not just an app, and BTC is not just a ticker symbol on a chart. Bitcoin is a network for keeping a shared record of who owns what without asking a bank, payment company, or government database to be the final referee. The big idea is digital scarcity. In the physical world, if I hand you a gold coin, I no longer have it. Online, copying is normal. Bitcoin tries to make a digital asset behave more like the gold coin, where spending it once prevents spending it again. Before Bitcoin, the hard problem was not sending a message. We already knew how to send signed digital messages. The hard problem was stopping the same digital money from being spent twice, especially when there is no central database deciding which payment arrived first. Traditional finance solves this with trusted middlemen. Your bank updates balances, reverses errors, blocks suspicious transfers, and settles with other banks behind the scenes. That system can be useful, but it also means users depend on permission, account access, operating hours, and institutional rules. Bitcoin takes a different path. Instead of one company owning the ledger, many independent computers keep copies of it. These computers follow the same rules, check every new transaction, and reject anything that breaks the rules, even if a miner or a wealthy user tries to push it through. When people say they own Bitcoin, they do not mean a tiny coin is stored inside a wallet app. The wallet holds private keys. Those keys can authorize movement of Bitcoin that the network already recognizes as spendable under certain conditions. A Bitcoin transaction is like an instruction that says, move this amount from coins I can spend to a new address. The private key creates a digital signature. The signature proves permission, while the key itself stays hidden and should never be shared. That transaction gets broadcast to the network. Full nodes check whether the signature is valid, whether the coins exist, and whether they were already spent. If the transaction fails those checks, honest nodes do not pass it along as valid money. Valid transactions wait to be included in a block. A block is a batch of transactions, plus a reference to the previous block. This reference is what turns separate batches into a chain, where each new block builds on the history before it. Miners compete to add the next block. They gather transactions, build a candidate block, and then search for a special number that makes the block's hash fit the network's current target. This is proof of work, and it is intentionally difficult to find. A hash is a one-way fingerprint of data. Change even a tiny part of the block, and the fingerprint changes completely. Miners cannot shortcut the answer. They keep trying different numbers until one miner finds a block hash that is good enough. Proof of work makes rewriting history expensive. To change an old transaction, an attacker would need to redo the work for that block and catch up with the honest chain that kept growing. The deeper a transaction sits under later blocks, the harder that becomes. If this kind of plain English crypto breakdown is useful, consider subscribing. We will keep the focus on how the systems work, what they are trying to solve, and what risks beginners should understand before trusting any crypto tool. Bitcoin does not make blocks faster just because more miners join. Roughly every 2 weeks, the network adjusts the mining difficulty based on recent block timing. The goal is to keep blocks arriving about every 10 minutes on average, not exactly every 10 minutes. Mining also creates new BTC. The first transaction in a block is a special transaction that pays the miner. It includes newly issued Bitcoin, called the block subsidy, plus transaction fees from users who wanted their payments included. Bitcoin's scarcity comes from its issuance schedule. The subsidy started high, then gets cut in half every set number of blocks. Over time, fewer new BTC enter circulation, and the total possible issuance approaches the well-known limit of about 21 million BTC. The important detail is that the limit is not enforced by a promise on a website. It is enforced by the software rules that nodes choose to run. If a miner creates more Bitcoin than allowed, full nodes can reject that block as invalid. Could humans change the software? Technically, software can be edited, but Bitcoin's scarcity depends on broad agreement among users, node operators, miners, wallets, exchanges, and businesses. A rule change that inflates supply would be rejected by many people because it attacks the main reason the system exists. BTC is the native asset of the Bitcoin network. It pays transaction fees, rewards miners, and represents the unit being transferred on the ledger. People use it for different reasons, including long-term holding, cross-border transfer, donations, savings experiments, and financial access where traditional services are limited. Settlement means a payment has become part of the shared record in a way that is increasingly hard to reverse. A card payment may feel instant, but behind the scenes, it can involve chargebacks, bank settlement, and several companies. Bitcoin settlement is about inclusion in blocks. When a Bitcoin transaction is included in a block, it has one confirmation. Each block after that adds another confirmation. More confirmations do not make a transaction mathematically impossible to reverse, but they make reversal more costly and less practical under normal network conditions. This is called probabilistic finality. Bitcoin does not have a central judge announcing final forever. Instead, confidence grows as more proof of work is layered on top. For small payments, people may accept less waiting. For larger transfers, they often wait longer. The base Bitcoin chain is not designed to process every small purchase on Earth directly. Its design favors simplicity, security, and decentralization over maximum speed. That is why fees can rise when block space is crowded, and why some payments may wait. Because base layer space is limited, people build additional systems around Bitcoin. Some services batch withdrawals. Some users rely on custodians. Payment layers can move smaller transactions more quickly, then settle back to Bitcoin later. These approaches add convenience, but they also introduce their own assumptions. Compared with Ethereum, Bitcoin is more limited, on purpose. Ethereum is built as a flexible platform for smart contracts and applications. Bitcoin's base layer is narrower. It focuses mainly on issuing and transferring BTC, with a conservative rule set that changes slowly. Compared with high-speed chains like Solana, Bitcoin usually feels slower and less feature-rich. That is part of the trade-off. Bitcoin prioritizes the ability for many independent participants to verify the system, rather than optimizing only for fast user experience or application throughput. Bitcoin is also treated differently from many crypto assets because it did not start as a company selling tokens to fund a roadmap. There is no active CEO of Bitcoin who can promise quarterly updates. That does not remove risk, but it changes the trust model. People keep talking about Bitcoin because it combines several unusual properties. It is digitally scarce, globally transferable, difficult to censor at the protocol level, and open for anyone to verify. Whether someone values those properties is a separate question, not a guaranteed investment outcome. A common misunderstanding is that Bitcoin is completely anonymous. It is better described as pseudonymous. Addresses are not names by default, but transactions are public. If an address becomes linked to a person or service, its history can often be studied. Another misunderstanding is that a wallet stores coins like a leather wallet stores cash. A Bitcoin wallet manages keys. If you lose the keys and have no backup, the network cannot reset your password. If someone steals the keys, they can sign transactions. When BTC is held on an exchange, the user may see a balance, but the exchange controls the private keys until withdrawal. That can be convenient, especially for beginners, but it also adds counterparty risk. The Bitcoin network and an exchange account are not the same thing. Proof of work uses real-world energy and hardware. Supporters argue that this cost is what anchors Bitcoin's security in the physical world. Critics argue that the energy use is wasteful or environmentally harmful. Beginners should understand that energy consumption is not a side effect. It is central to the design. Mining can also become concentrated, where electricity, hardware, capital, and regulation are favorable. Mining pools help smaller miners combine rewards, but pools can become influential. Bitcoin's security model assumes competition, monitoring, and the ability of participants to react if power becomes too concentrated. BTC can move sharply in market price, and legal treatment can vary by country. Those market and regulatory risks are separate from whether the protocol produces blocks. Bitcoin can work as software while still being risky for users, businesses, miners, and investors. Bitcoin changes slowly because no single party can simply push an upgrade onto everyone. Developers can write code, miners can signal support, companies can prepare, and users can run nodes. But durable changes need broad agreement, which makes innovation slower and sudden rule changes harder. You may hear Bitcoin called digital gold. The comparison points to scarcity and independence from central issuers. But it is not literally gold. It depends on software, networks, electricity, markets, and human coordination. Analogies help, but they should not replace understanding the mechanism. So, what is Bitcoin? It is a decentralized settlement network with its own scarce asset, BTC. Nodes enforce the rules. Miners add blocks through proof of work. The supply schedule limits issuance. Confirmations make payments harder to reverse. The trade-off is speed, complexity, energy cost, and personal responsibility. If one part of Bitcoin still feels confusing, ask about it in the comments. You can also suggest the next topic, whether that is wallets, mining pools, the Lightning Network, stablecoins, Ethereum, or how crypto exchanges actually hold customer funds.